Yeah, friends, welcome back. This is what we are discussing in our previous class, and I hope you have understood the concept. I gave an example that let us say profit before tax is 100 rupees, and there are two options I told you. One company can go for equity, 200 rupees, or it may go for debt, 200. First case, let us say he has taken a debt of 200 rupees with interest 10%. Then he has to pay interest PBIT, profit before interest and tax, minus interest, we get profit before tax, that is 80. From that 80, assuming tax is 25%, company has to pay tax 20 rupees. Profit after tax is 60 rupees. So 60 rupees is the wealth addition or the value addition to the company. 60 rupees will be added to the reserves of the company. Okay, I think you are agreed. On the other hand, let us say instead of taking debt, company is going for equity. Interest will be 0. Profit before tax will be 100 rupees. Tax has to be paid 25. So 25 rupees tax has to be paid, whereas in case of debt, we are paying tax 20 rupees. And profit after tax will become 75. Let us say same dividend 20% company is paying, then 55 rupees will be the value addition in the company's wealth. Okay, now you have seen in case of debt, value addition is more, 60 rupees, 5 rupees more. And in case of equity, value addition is 5 rupees, 55. Why this thing happened? Because in case of debt, we are paying less tax. We are paying here 20 rupees, here we are paying 25 rupees. Okay, that means by doing this simple change in the capital structure, shifting from equity to debt, the company is able to maximize the value to the extent of 5 rupees. Are you understanding this example, or you have any query? This is a
So the 7.5 thing,
yeah, 75 rupees.
so 7.5 the percentage that came, that one.
7.5% came. Okay, this is the cost of capital came 7.5%. Why cost of capital came 7.5%? You see, in case of equity shareholders, I am paying 20 rupees and my cost of capital is 10%. Why 10%? But 200 rupees, 20 rupees, 10%. In the debt holder, also my cost is 10%. But 10% is the pre-cost debt. Oh, sorry, pre-tax debt. Pre-tax debt is before considering tax. But if you consider the tax effect, by taking this debt, I am saving 5 rupees as my interest, as my tax. Okay, so otherwise I was normally supposed to pay tax 25 rupees. Since I have taken a debt, I am paying 20 rupees, so 5 rupees by saving. So 20 rupees I am paying, 5 rupees I am saving. So effectively, if you find out that how much I am paying 15 rupees. And this 15 rupees and 200 rupees, it comes to 7.5%. Are you getting this?
So this calculation,
Yes, sir.
this is good, okay. But the other side is right. So the equity shareholders are not getting the dividend, right? That is a drawback.
Yeah, that is what we are saying. No, equity shareholders are getting dividend. Equity shareholders are getting dividend. Dividend is not affected. Dividend here, they are getting 20 rupees. Debt holders are getting 20 rupees. But the value addition, you see, ultimate objective of the business is to maximize wealth. Company's wealth maximization, if you see, here what happened, company's wealth is maximized to the extent of 60 rupees. Company is becoming richer to the extent of 60 rupees. Here, company is becoming richer to the extent of 55 rupees. Okay, so wealth maximization or value maximization, if you give as an objective of financial management, if you see here, it is always better to go for debt. From tax point of view, there are other logics, other theories are there, you know, capital structure theories are there. If you want, you can read it. And in my YouTube channel also, you can find out so many videos on capital structure theories. There are different theories. In which situation you will go for equity, which situation will go for debt, that's a different story. But only if you think from tax point of view, more debt is better, because if you take more debt, what will happen? your value addition will be more. Okay. Instead of 55, you can add 5. Here, what has happened? Why it is less 5 rupees? Because 5 rupees is going to government as tax. 5 rupees extra is going to government as tax. The government is getting 5 rupees. Are you getting it?
Sir,
Yes. Yes.
so sir, overall cost would be the summation of the cost of debt and equity.
Overall cost is a different concept. Suppose I take both debt and equity taken together. Now you know debt cost is 200, debt cost is 10%, equity cost is 7.5% effectively. Overall cost is weighted average cost. Okay, that means half of this thing. I'll average it out, what will be the cost? That is my overall cost. Overall cost means weighted average cost of all the components.
Okay, sir.
Are you getting? So this is how. Now I think you have understood. From income tax point of view, you see, income tax law suggests us to give more in the capital structure, we will have more debt. Because when we have more debt, what will happen? We'll be paying more interest. When interest is paid more, my profit will be reduced. The moment I'm paying interest, my taxable profit is reducing. When my taxable profit is reducing, I'm paying less tax. Okay. But it depends upon many other things. What kind of capital structure you should have. So other things are there. The concepts of financial management, there you have to think where, which situation you have to go for more debt, which situation you have to go more equity. Well, friends, now few more things only I'll be discussing with you. What is capital structure? What is financial structure? You have understood. Now you have also understood the impact of this thing, tax on capital structure. Now you see, for again to do this analysis, first of all, we need to know what is cost of equity, how it is getting affected. This concept also you might have learned in financial management. Also, you'll be learning. So far as equity shareholders are concerned, this is one method of arriving at its cost is to find out the dividends. So cost can be arrived on the basis of dividend. You can say dividends are the cost of equity. Okay, this is again one method of learning this. Other methods purposefully we are not telling you because we are not learning financial management here. We are learning tax impact. Okay, so there are various other methods of computing cost of equity, but for our understanding, we'll take cost of equity is dividend. So far as cost of interest is the cost of debt is concerned, we'll take cost of debt is our interest. Interest is the cost of debt, right? And this cost of debt has got two things. One is pre-tax cost of debt, post-tax cost of debt. Here again, you see, I'm showing the same example. You see, let us say equities, one company is having equity, and same thing, another company is having equity of 100 and sorry, debt of 100. Okay, one company is all equity farm, equity 100, another company is having debt of 100. The debt interest is 8%. Are you seeing this example?
Yes, sir.
Now let us say both the companies earned at the rate of 10%. Consequently, their profit before interest and tax is 10 rupees, 10 rupees. First company will not be paying any interest because it has got no debt. Second company is paying interest of 8 rupees because 8% on 100. Understood up to this?
Yes, sir.
Okay. Profit before tax, if you see, first company has got 10, second company has got 2 because profit before interest and tax minus interest. Here they have to pay tax. This company has to pay tax on, equity farm has to pay tax on 10 rupees. This company has to pay tax on 8 rupees. And here you see there is a 7. Okay. Here he has to pay, here he has to pay tax on 2 rupees. There is a saving. If you consume tax, if you assume that tax rate is 30%, this company has to pay 3 rupees. This company has to pay 0.6. Understood? Substantial saving in tax. So 0.24, that is 3 rupees minus 0.6, 0.24 is the saving in tax. So my cost of debt is 8%. So, but I'm saving 2.5% also. So my effective cost of debt is, you see, 5.6%. You can call it as the post-tax cost of debt is 5.6%. Did you understand? And this cost has got impact on capital structure. We decide capital structure, keep in mind the cost of debt. So debt has effect in reducing the cost of capital. So overall cost can be reduced if you keep more debt, so long as interests are tax deductible, interests are deductible as an expenditure. Understood this concept?
Sir, K small d and K capital D.
Yeah, K small d, capital D, I use that abbreviation. When it says K capital D, that means cost of debt before tax. Okay. And when you say K small d, like here, K capital D, yeah. K small d, it is the cost of debt after tax, post-tax. Suppose pre-tax cost of debt is 8%, but post-tax cost of debt is 2.4, sorry, 5.6%. So this is a formula how to convert pre-tax cost of debt to post-tax cost of debt. You see, K small d, that is post-tax cost of debt, is equal to pre-tax cost of debt, K capital D, into 1 minus tax. So 8% into 1 minus tax rate is 30%, 0.03. It comes to 5.6% directly. You can calculate. This is just to help you quickly calculate what is post-tax cost of debt.
Okay, sir. Sir, here MAT will not come into picture.
No. We are not talking about MAT right now. MAT is
Okay.
not coming into picture. Okay, normal tax rate 30% we are thinking. So
Okay,
simply you see, you paid in interest how much? 8 rupees. Okay.
Yes, sir.
And you are saving tax because instead of 3 rupees, you are paying 0.6. You are saving 2.4. 2.4 rupees you saved from tax. So 8 rupees you paid, but you saved 2.4. So 8 minus 2.4. So 5.6% is your post-tax cost of debt.
Yes, sir.
Okay, understood. So now, on depending upon the tax rate, your cost of capital may change. If the tax rate is not 30%, 25%, cost of capital may change. If some companies can pay tax at 15%, this will also change. Some company MAT may be applicable, so this will also change. So all these things you have to keep in mind when deciding the capital structure. Okay.
Okay, sir.
Now, this is one concept you have to learn. One more concept we need to learn is that interest is fine. Interest has got impact, companies getting tax saving. There is one more tax which is called as the dividend distribution tax. When the moment you are getting equity in your capital structure, you have to pay dividend, is it not? And on dividend, there was a dividend distribution tax, but thankfully, for assessment year 2021-22, this has been abolished. There is no dividend distribution tax. So this is again good thing. Otherwise, company for equity shareholders, first of all, company is finding cost of capital is more. But in addition to that, company has to also pay DDT. DDT is dividend distribution tax. So thankfully for 21-22, the dividend distribution tax is not there. So you are relieved. Otherwise, cost of equity will be further. Understood?
Sir, but for next year onwards, it will be,
next year
right?
means it is abolished, means for year onwards, for this year
Okay,
onwards.
abolished.
It is
Okay,
not.
okay, sir.
Now, I will not say it is abolished, but right now it is not there. It is expected that in the future also it will not be there. It may come back also after some time, but right now for near future, we don't see it. Dividend distribution tax will not be there. Okay, but when dividend distribution tax is not there, one more thing company has to take care. When it is paying dividend, it has to deduct tax at source. So there is nothing wrong in that. Tax, when company is paying dividend, it will deduct tax at source. The TDS company has to deposit. At the rate of 10%, company has to deduct tax at source. Okay. But if the shareholder is not having PAN, if PAN is not there, then he has to deduct TDS at the rate of 20%. This also you have to remember. Okay. So on dividend, TDS is applicable when dividend income exceeds rupees 5,000 rupees. Normal rate of TDS is 10%. And if the shareholder doesn't have PAN, the rate of tax is 20%. Okay. Is it clear?
Yes, sir.
Okay. Now, next concept is, and this will be our last concept. This is TDS on interest. On interest, when a company is paying interest to the debt holders, here also company has to deduct interest under section 193 of the income tax. He has to deduct TDS. And here TDS rate is 15%. 15% tax has to be deducted on interest. And that money which is deducted, that also has to be deposited with the government's account. If it is not deposited, if there is delay in deposit, then 1.5% per month is the rate of interest which company has to pay. Okay, so these are the provisions which relates to, these are the tax provisions relating to company's capital structure or company's, you can say, financial structure. This is how tax has got an impact on this. Therefore, it is said without knowing the tax issues, it will be very difficult to take any managerial decision. Understood? Now you have seen how tax has got impact on cost of capital according to on profitability, how it affects the cash flow of the entity. Right. So therefore, you can say tax is well connected with the topic financial management, which is that's why we need to keep in the mind when you are deciding the capital structure. We need to keep in the mind what is the consequence of this tax, or what is the impact of tax on the capital structure, and in which situation my wealth can be maximized by changing the capital structure. Those issues also we need to learn. Is it clear up to this?
Sir, like TDS is different from our normal tax, right? At source, which is deducted, and which is final computed.
Yes. Yeah, TDS is different. TDS means tax is deducted at source, but that is not the final tax. Don't think that that is the only tax. Okay, TDS laws, our TDS provision says if this kind of payment is there, tax has to be deducted at source. But by any chance, your tax liability is not there. Let us say your tax liability is not there. The tax has been deducted. Then you can get it refunded. Okay, TDS is not the final tax. TDS is a deduction, and it is something like government is collecting in advance from you. And if your liability doesn't exist, the government will pay it back. Is it clear to you?
Yes, sir. Like, sir, in IT return filing, we get some refund.
Yeah, you get some refund if there is some TDS, if there is some advance tax. So you have to compute what is your tax liability and what is the tax already it has been paid. Then you can claim a refund.
Okay, understood.
So friends, we'll stop here today. We'll catch up with some other new concept in your next class. Thank you very much.
Thank you, sir.
Thank you, sir.
Thank you.
Thank you, sir.
Thanks a lot.
Thank you, sir.